Lori, start with you. I would say, at least, the market's sort of liked this week. Why?
So look, I think that this earnings season has been, quite scary when it's been far off in the distance. But now that things are here, what I keep hearing from investors is that they didn't believe the lofty sell-side earnings expectations to begin with. I think earnings were already de-risked much more in investors' minds. I also think investors are seriously entertaining the idea that we may not have a recession after all. So I hear a lot of people in my meetings talk about the soft landing looks like it's probably going to happen. And then also, I think people are starting to sniff out the end of Fed hikes, and people are ready to turn a new chapter in this market. And so I think on balance, a big sigh of relief.
So Sharmin, what about the Fed, which is tied into economic numbers? We got a lot of economic numbers on. And I looked at them, and some were positive, some were negative. I wasn't sure where they were pointing. What did the economic numbers tell us?
From our perspective, for the whole next several months, we are going to get a mix of good numbers and then a mix of bad numbers. That's why in terms of our 2023 outlook, we have a range of 45 to 55% probability for a recession. And we're making the point that there is a lot of uncertainty out there. In fact, on the cover of our 2023 outlook, we have an image, and the outlook is called Caution, Fog Ahead. So the whole purpose is to say that outlook going forward is very foggy. And we need to make sure that clients don't sway too much from one side to the other. Don't become too optimistic and position yourself for huge upside in equities, but don't become too pessimistic and position yourself for incredible downside.
So that makes it hard to know exactly where the Fed is heading next. How much of what Lori is talking about with the earnings expectations are tied into where the Fed is going, particularly on the discount rate?
So our view is the Fed's going to be around 5 plus or minus. Generally, the Federal Reserve has actually not tightened to the full extent that the market has anticipated. So there's a bit of realization of that. When we're looking at the data, you get some data in terms of financial conditions tightening too much, and then next week you get different data with inflation or non-farm payroll numbers, and people worry about the Fed tightening too much. So we're going back and forth in that. But the biggest factor, I think, in driving earnings, as you mentioned, was that people's expectations were so negative based on the data from financial conditions, based on buy-side expectations. At one point, people were thinking we could have earnings down 25%. And earnings expectations have come down. But the most amazing thing now is with the earnings we've gotten this quarter so far, when we get misses, when companies actually miss, instead of, in fact, the market trading off, which it typically has, based on work from our colleagues in global investment research, the stocks go down 2.2%. This time, this cycle, they've actually gone up 1.5%. That's a huge spread. So it's to Lori's point that the market was so negative, too pessimistic on earnings. And on recession, 2/3 of forecasters thought we're going to have a recession. And that seems a lot less likely now.
What do you think the percentage is?
We have said 45 to 55%, and that's the whole point of our theme for the outlook.
So, Lori, it was expected as we went into 23, earnings would be the big story as opposed to the discount rate. From your point of view, has the market fully discounted, or perhaps, as Sharmin suggests, over-discounted the takedown in the earnings rate?
Well, I think one thing that's fascinating is that even those sell-side numbers, so the people, my colleagues in investment research, right, who cover stocks, even though their numbers are still too high, this is the fastest pace of earnings downgrades that we've actually seen since the financial crisis. And so I don't think people really understand how much work the sell-side community has been doing. They're still behind, but they've really just done a lot of work in getting those numbers down already. I mean, the other thing we see typically also is that when you have earnings downgrades in any given year, they're typically done by March or April. I've been talking a lot to investors about that recently, and I think investors, they're trying to game it a little bit, right? They still think the numbers need to come down. They think we should bottom in March, but if you think we're going to bottom in March, well, go ahead and get positioned for that now. So there's a little bit of gamesmanship going on here as well.
And where are you on the likelihood of recession that Sharmin was talking about?
So I have the luxury of not being our economist, and I don't have to make that call, but I agree with my colleague Tom Porcelli when he says, I don't know if we're actually going to call it a recession in the end. It might be something similar to 2015, 2016, where parts of the economy are in recession, but we technically skate by. It's not going to feel fun. It's going to kind of smell like a recession. Maybe it's not quite going to meet the technical definition. But either way, I think if that's what we get, we probably paid the price for that at the October low when we were down 25% from peak.
So, Sharmin, you said 45 to 55% chance of recession. How important is it where it comes in the year?
It's very important because if we get it sooner, the market would be discounting that, and at the end of 2023, the market will be looking to 2024 earnings. And so Our base case is we're going to have actually reasonably attractive equity returns. For the whole year, we've expected about 13% is our base case. So somewhere around 42.50 for the S&P 500. And so if we have an early recession, people won't care about it that much, and especially if it's going to be a mild recession. The main issue would be if the Fed actually becomes a bit too aggressive because of a handful of inflation numbers, would we actually see a recession towards the end of the year? And that would not be good for equity markets.
All right, Sharmin, it's at 42.50 for the end of the year for the S&P 500. Where are you?
So we're at 4,100. We're a little bit north of the consensus. We have said that some of our models are pointing us to around 4,500, 4,600. And that's not our base case, but we can see how you can get there. One model, for example, looks at how much multiples might expand if we see the 10-year end up around 3.5 and a couple cuts from the Fed at the end of the year. That gets us a little above 4,500. And we also talk a lot about how sentiment was so depressed at the end of last year. You typically see a 15, 16% return on a 12-month forward basis off of those kinds of levels. So I can see how you can get to a number above my 4,100.